delivery love triangle this month. Gold just went to delivery yesterday, and it looks like it's going to pull gold open interest down below 400,000 contracts, possibly, not for sure, but we're getting pretty close. And if we go below 400,000 contracts, it'll be the first time since the end of the last bear market. I'll show you a chart that shows that these levels of open interest are bear market levels of open interest. Doesn't mean that gold's in a bear market, but it means that the sentiment is similar to a bear market in gold. Futures are getting less and less popular as the price rises. This is basically a sign that the physical markets are starting to take control of the pricing mechanism for gold, which is what we have been expecting all along.
In today's news recap, Bank of America is full of confidence it will hit 4,000 within the year. Commodity analysts at Bank of America are becoming increasingly optimistic about the outlook for gold. In a report released by BofA on Wednesday, the precious metals team led by Michael Widmer predicted that the likelihood of gold prices reaching $4,000 per ounce in the second half of this year is growing. This latest forecast from BofA is one of the most aggressive among major Wall Street banks. It is worth noting that in March this year, Widmer and his team had forecast that gold prices would reach $3,500 by 2027. However, this target was achieved in less than a month. Despite BofA's continued bullishness on gold, its analysts pointed out that a series of specific conditions must be met for gold prices to reach the $4,000 target. The analysts wrote in the report, to further push up gold prices, investment in gold needs to increase and jewelry demand must stabilize. Specifically, for gold prices to reach $4,000 per ounce, investment needs to increase by 18% year over year. They explained, this may sound like a lot, but purchases in 2016 and 2020 both exceeded this figure, indicating that it is possible. In addition, regarding other catalysts behind the rise in gold prices by the end of the year, BofA pointed out that geopolitical uncertainties triggered by global trade are the biggest driving force for gold price increases before the end of 2025, and concerns about the fiscal outlook of the U.S. government may trigger the next wave of gold price increases. The report stated, tariffs are an indispensable part of Trump's policy toolkit, but unfortunately, they also affect inflation expectations. This puts the U.S. Fed in a dilemma. A slowdown in economic activity coupled with upward pressure on the overall price level suggests that real interest rates will remain low, which also supports gold prices. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, turn on notifications, and check our new Numismatics Handbook. Most stackers want to get active, but swapping their metals for dollars isn't an option. There's plenty of opportunities in the overlooked numismatics world. Mastering U.S. coins, key dates, and errors pays off by multiplying your ounces and capitalizing where others aren't paying attention.
Quickly here, we have what I call a gold delivery open interest love triangle. Open interest right now is at about 411,298 contracts. How do I arrive at that number? Because the last reported number on the COMEX site, this is the CME on the left over here, is 426,571 contracts. There were 15,273 deliveries yesterday, which is going to take off of that open interest, and we have a total of 411,298. And we have what looks like another 5,000 or 6,000 contracts still open that will go to delivery. All we need is one little down day in open interest, which will probably follow a down day in the gold price, which has been happening. It's been very volatile out there in the gold market, and I think this is one of the reasons that futures are less liquid because of the Basel III regulations, which makes it more difficult for banks, for bullion banks, to act as market makers in this market. So does Basel III positively or negatively affect the gold price? No, it just makes it more volatile by contracting liquidity in the futures market, which appears to be what it's actually doing. Now, 400,000 in open interest. You can see open interest levels. I put a little thin red line at exactly the 400,000 mark in open interest. If you look in a magnifying glass, which I did, I zoomed in on this about 500% just to make sure I got the numbers right. This number in open interest has not occurred since the beginning of 2016, right over here at the edge of this oval. This was the end of the last gold bear market. You can see it corresponds to the price right here of gold at about 1045.
We're here. We're queer. We don't want any more bears.
We're here. We're queer. We don't want any more bears.
1045, 1046, maybe the low was. Whatever it was about 1050. And from there on, open interest has never reached 400,000 contracts again, but it looks like it is about to, except this time the open interest is going down and the price is going up, which means that the physical markets are taking control. And at some point, the futures market is going to wake up. And once it does, there's going to be a lot of speculative tailwinds for the gold price. It could bring it significantly higher very quickly. We've seen huge moves in the gold price on very small moves in open interest, a big move in open interest in the positive side, meaning open interest rising, will lead to huge moves in the gold space. You'll see it in the coming weeks and months, especially as we get closer to the end game and leading up to the final crash in the dollar. This is the Treasury's account at the Federal Reserve. When this goes to zero, they have to raise the debt ceiling. We can see from April 30th to May 28th, that's exactly 4 weeks, we have gone down in this account $241 billion. If you calculate that, there's about 7.5 weeks of cash left. It will probably be 9, 10, 11 weeks, something in that range, because cash will come in from the various corporate tax days from now until August. But this cash is going to drain. It's going to drain faster because they have to cut the bill size because they're already at the debt ceiling.
In today's news recap, Trump spurs questions about safety of Germany's gold in New York. The safety of Germany's gold reserves held overseas and in New York in particular, until recently mainly a talking point for the country's far-right party and gold bugs, is becoming a matter of public debate with Donald Trump back in the White House. The Bundesbank, Germany's central bank, has the world's second largest stock of gold at 3,352 tons. 1/3 of it is stored at the Federal Reserve Bank of New York for reasons dating back to the Cold War and the monetary system created in the wake of World War II. Those holdings have occasionally attracted scrutiny in the past, and the right-wing Alternative for Germany has embraced calls for a return of the country's gold back home. U.S. President Donald Trump's confrontations with long-standing allies over trade and security and his attacks on the Fed have revived the issue in recent weeks, and more mainstream voices have joined the debate. Germany's Taxpayers Federation sent letters this week to the Bundesbank and the Finance Ministry calling on them to repatriate the gold stored in the United States. Markus Farber, an influential member of the European Parliament for Germany's ruling Christian Democrats, said the United States was no longer the reliable partner it used to be. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
We'll see this go to zero, and once it does, they're going to have to raise money, but they can't raise any money because all the money is being used by the repo market. We're going to see that in this chart. This is the next chart I wanted to show. This is the repos to reserves ratio, how much bank reserves, what proportion of available bank reserves are being used by the repo markets. I go over this chart every few weeks just to update where we are, and we can see we're still on the same trajectory, heading up inexorably to that 83% repocalypse ratio mark over here. This is 2019 when there was a repo crash, a repocalypse, and repo rates went to about 10% overnight. We are headed there. We're going to get there within the next few weeks. You can see here that we're at 79%. The interesting thing about this number, 79%, is that it's outside of a month turn. The month turn is actually Today, this is 2 days ago here, May 28th. This is always a day behind. So today, we will see the repo rates for May 29th. And then on Monday, we'll get the repo rates for May 30th. And those will be a spike. You'll see this spike probably above the 83% repocalypse ratio mark, but it has to stay there sustained for a few weeks in order to trigger something. But we're getting there, and we will get there, and there's not enough dollars to fund both the repo markets and the federal government. That's two trains coming at each other at the same time, and there's going to be a crash. Let's look briefly at the 10-year minus 2-year yield curve spread right now. It's at 51 basis points. We can see whenever it goes below zero and then goes back above zero, there is a recession, happens every time. This time we're at 51 basis points. The last time, we're going to start at 1990 and go into the more recent past. So we're going to start at the next slide here. We see the 10-year minus 2-year yield curve spread. In 1990, at what point did we come into a recession at that shaded point? July 2nd, 1998, 18 basis points. We're now at 51, so we're beyond that. So we could hit a recession anytime. We can see in February 28th, 2001, we hit exactly where we are now, 51 basis points by the time a recession was triggered at the shaded area here on February 28th, 2001. And most recently, 2008, we got all the way up to 99 basis points for all intents and purposes, 1% yield spread between the 10-year and the 2-year. So we do see here a trend. It's been going up every time that we hit a recession. First, we had 18 in 1990, then 51, and then 99, and now we're at 51 again.
What do you think of Rafi's take? Do you agree with him? Is Basel III good for gold and silver in the long run, or is it just another chicanery by the central banks to keep printing paper? Let us know in the comments section down below. Subscribe if you have not yet done so, and check this video right here because it's a perfect fit for you. I'll see you on the other side.